There's a pattern hidden in the economy that most people will never see. It's not taught in schools. Financial advisors don't talk about it. The media ignores it completely. But this pattern has predicted every major economic collapse for the last 200 years with terrifying accuracy. It predicted the crash of 1873. It predicted 1929. It predicted 2008. And right now, this same pattern is pointing directly at 2026. Not 2027, not sometime in the future, 2026. The mathematics are precise. The historical evidence is undeniable. And if you understand what's really happening, you can see the crash coming months before everyone else panics. This isn't about conspiracy theories or fear-mongering. This is about cycles. Economic cycles that repeat with the regularity of seasons. Just as winter follows autumn and spring follows winter, economic collapse follows economic boom with mathematical certainty. The cycle we're going to examine today was discovered by a Russian economist named Nikolai Kondratiev in the 1920s. He studied economic data going back to the 1700s and found something remarkable, a long wave pattern that repeats every 40 to 60 years. 4 distinct phases: spring, summer, autumn, winter. Growth, prosperity, stagnation, collapse. And we're deep into the winter phase right now, the phase that always, without exception, ends in financial crisis. Kondratiev didn't just theorize about this. He documented it with decades of price data, interest rates, production statistics, and commodity prices. He showed that these long waves were not random fluctuations, but predictable patterns driven by technological innovation, debt accumulation, and the destruction of old economic structures to make way for new ones. His work was so accurate and so threatening to the Soviet narrative of permanent communist prosperity that Stalin had him arrested in 1930. He died in a labor camp in 1938, but his cycle lived on, and it's been proven right again and again. Let me show you how this works. The Kondratiev wave begins with spring. This is the recovery phase after a major crisis. Infrastructure is rebuilt. New technologies emerge from the ashes of the old economy. Debt levels are low because the previous crisis destroyed most of the bad debt. Interest rates are low, prices are stable. Optimism is cautious but growing. This is what happened after World War II. The 1950s were a spring phase. America rebuilt. Suburbs expanded. The interstate highway system was constructed. Television became mainstream. The economy was growing, but inflation remained modest. Then comes summer, the boom years. The technologies introduced during spring mature and spread throughout the economy. Employment is high, wages rise. Inflation starts to pick up as demand outpaces supply. Everyone feels wealthy. The stock market climbs steadily. This was the 1960s, the space race, the golden age of American manufacturing. High employment, rising wages, and growing confidence that prosperity was permanent. But beneath the surface, problems are developing. Debt levels are rising. Inflation is accelerating. The seeds of the next phase are being planted. Autumn arrives next. This is the plateau phase. The peak has been reached, but nobody wants to admit it. Growth slows. Inflation becomes a serious problem. Central banks start raising interest rates to fight inflation, which slows the economy further. Asset prices become detached from underlying values as people chase speculation instead of productive investment. Debt continues to accumulate because everyone believes the boom will return. This was the 1970s and early 80s. Stagflation, high inflation combined with slow growth, oil shocks, rising unemployment. The economy felt like it was stuck. And it was stuck in the autumn phase, heading toward winter. Winter is the crisis phase. The accumulated debt becomes unpayable. Asset bubbles pop. Banks fail. Unemployment spikes. Deflation or a severe recession takes hold. This is the Great Reset, where all the excesses of the previous phases are purged from the system. Businesses that survived on cheap credit go bankrupt. Over-leveraged investors lose everything. Only those who prepared for winter survive to see the next spring. This was the early 1930s, the Great Depression. Thousands of banks failed. Unemployment hit 25%. The stock market fell 89%. It took 25 years for stocks to recover to 1929 levels. That's a Kondratiev winter. The cycle doesn't stop there. After winter comes a new spring, the 1950s and 60s, as we mentioned. Then summer again in the 70s, autumn in the 80s, and winter arrived in 2008 with the financial crisis. But here's the critical point. The 2008 crisis should have been worse, much worse. It should have been a full Kondratiev winter that cleansed the system completely. Instead, governments and central banks intervened with unprecedented force. They bailed out the banks. They dropped interest rates to zero. They printed trillions of dollars. They prevented the natural winter from running its course. What they actually did was delay winter, not cancel it, delay it. And that means the winter that was supposed to fully unfold in 2008 through 2010 is still coming. It's been postponed for 15 years through artificial monetary policy and debt expansion. But you cannot postpone winter forever. Eventually, the accumulated imbalances become so large that no amount of intervention can prevent the correction. That point is approaching now. 2026 sits at the intersection of multiple cycles, all pointing toward the same conclusion. Here's the truth that most people are missing. 2026 isn't just a random date on the calendar. There are clear warning signs embedded in the economy that point directly to this year. And if you pay attention, you can see it before the crowd panics. One of the most reliable signals is the yield curve inversion. This happens when short-term interest rates climb above long-term rates, flipping the normal curve upside down. Historically, every U.S. recession since 1950 followed this pattern, no exceptions, no coincidences. The yield curve flipped in July 2022 and stayed inverted for more than 2 years, one of the longest stretches in modern history. It finally returned to normal in September 2024. Historically, recessions hit 6 to 18 months after the curve flips back. That puts the likely window from March 2025 to March 2026. That's your first red flag. Next, look at corporate credit spreads. This shows the gap between borrowing costs for the safest companies versus riskier ones. When spreads are tight, the market feels calm. When they widen sharply, it's a warning that investors are fleeing risk. After years of being narrow, spreads started widening in late 2023 and accelerated through 2024. Past cycles show that spreads start widening 12 to 24 months before a crisis hits. That means late 2025 to late 2026 is the danger zone. Another critical signal is the velocity of money, the speed at which cash moves through the economy. When confidence is high, money changes hands fast, fueling growth. When confidence drops, money slows down, people hoard it, and the economy contracts. The last peak occurred in early 2022. Past cycles show recessions follow 24 to 36 months after this peak. That gives a window from early 2024 to early 2025. The clock is already ticking. Household debt is also flashing danger lights. Debt levels as a percentage of disposable income spike before every major downturn. 2007, 1989, 2000, you name it. Right now, credit cards, auto loans, student loans, and mortgages are all near record highs. Once debt payments exceed 15% of disposable income, a crash usually follows within 18 months. That threshold is hit in mid-2024, pointing toward late 2025 to early 2026. And here's the kicker: commercial real estate. Around $1.5 trillion in CRE loans must be refinanced between 2024 and 2027. The peak of that refinancing wall hits 2025 and 2026. These loans were made when interest rates were 2 to 3% and are now being refinanced at 7 to 9%. Many buildings simply can't handle the higher payments. Defaults will cascade, regional banks will fail, credit markets will seize, and the broader economy will follow. The most dangerous period is the first half of 2026. That's when the dominoes are set to fall. Here's the bottom line: multiple independent indicators, the yield curve, credit spreads, money velocity, household debt, and commercial real estate, are all pointing to the same window, 2026. Ignore them at your peril. Then arrives intervention. Governments and central banks scramble. They throw everything at the problem. Interest rates are slashed to zero or even negative. Trillions are printed. Banks get bailouts. New lending programs are launched. Fiscal stimulus floods the economy. Markets stabilize, temporarily. People breathe a sigh of relief. Crisis averted, they say. But it's only a mirage. Intervention doesn't solve the root issue. It merely delays the inevitable. This phase can last 3 to 12 months, depending on how aggressively authorities act. For our timeline, that's summer through fall of 2026. Following that is the secondary collapse. People finally realize the intervention failed. Markets that surged on stimulus begin to fall again, faster, farther, harder. Confidence shatters. Unemployment spikes. Corporate bankruptcies accelerate. Tax revenues plummet, forcing governments to borrow just to keep basic services running. Social unrest escalates as people lose jobs, homes, and savings. This is the core of the quandary of winter. Typically, it lasts 18 to 36 months. In our timeline, we're looking at late 2026 through 2028. Finally, stabilization and reset arrive. Once the system has been purged, bad debts liquidated, zombie companies gone, and asset prices drop to levels supported by fundamentals rather than speculation, the groundwork for a new cycle emerges. Survivors of the winter have capital. Assets are cheap. New technologies are emerging. The next spring is ready to begin, but only after years of pain. For our timeline, that phase wouldn't arrive until 2029 or 2030 at the earliest. Hook for retention. If you think the system can recover without preparation, think again. Every crack, every contagion, every failed intervention gives a critical opportunity if you know when to act. Stay tuned, because the real lessons from winter arrive in the next chapter. Now to see how the first true victims of this cycle will reveal the cracks you need to watch, and how to position yourself before the dominoes fall. The fourth stage is the secondary collapse. This is when reality hits hard. Interventions fail to fix the system. Markets that briefly bounced on stimulus begin to tumble again, this time with far more intensity because confidence is shattered. Joblessness surges. Corporate bankruptcies snowball. Tax revenues crater, forcing governments to borrow even more just to keep basic services running. Social unrest escalates as people lose jobs, homes, and savings. This is the core of the quandary of winter. Typically, this phase stretches 18 to 36 months. In our timeline, we're looking at late 2026 through 2028. The fifth and final stage is stabilization and reset. After the economy has been thoroughly purged, after bad debts are cleared, zombie companies collapse, and asset prices drop to levels supported by fundamentals rather than hype, a new cycle is laid out. Survivors emerge with capital. Assets are undervalued, new technologies are rising, and the next spring is ready to start. But this phase doesn't arrive without years of hardship. In our timeline, it wouldn't appear until 2029 or 2030 at the earliest. Understanding this cycle isn't about trying to guess every twist. It's about recognizing the late stage of a major wave and positioning wisely. Those who understand quandary of winters don't try to time the market peak. They prepare early. They hoard cash during autumn. They avoid excessive debt. They don't chase speculative assets just because everyone else seems to be winning.
They accept short-term underperformance in exchange for long-term survival and the chance to buy assets at deep discounts during the winter. History shows that correct positioning before a commodity winter can create generational wealth. Investors who bought stocks in 1932 and 33 at the depths of the Great Depression saw returns unmatched in normal times. Those who scooped up real estate at foreclosure prices in 2009 and 2010 built fortunes that lasted generations. Opportunities like these only appear once every 50 to 80 years. If you're ready, if you have capital while others panic, you can buy assets at 20 to 30 cents on the dollar. When markets recover, that 20 cents can turn into a dollar, a 400 to 500% return. But preparation demands going against instinct and ignoring social pressure. During the autumn phase, which is where we are now, everyone appears to be making money. Neighbors brag about gains. Media hails new highs. Experts insist this time is different, that technology has rewritten the rules. Staying cautious feels like you're missing out. That's exactly the test. Those who resist the urge to chase returns during autumn are the ones who will survive winter and thrive in the next spring. Here's what you need to do. Stocks, reduce exposure dramatically, not fully to cash, but from 90% to 40 to 50%. Build a cash position to deploy when prices plunge. Real estate, especially leveraged investment properties, reassess your ability to service debt if rents drop 30%. If not, selling early might preserve equity that would otherwise evaporate. For consumer debt, credit cards, auto loans, and personal loans, paying down balances is crucial. Debt is an anchor in winter. It forces you to sell assets at the worst possible time just to meet payments. Being debt-free provides freedom. You can weather the storm. You can buy when others are forced to sell. If you hold significant capital, consider diversification differently. Not across stocks and bonds, they'll likely fall together, but into assets that retain or gain value in crisis. Physical gold and silver, productive farmland, energy-generating assets, and businesses that supply essential services no matter the economy. These aren't speculative plays. They're insurance against collapsing paper assets. Psychological preparation may matter more than financial preparation. Winters test resolve when everyone around you is panicking. When headlines scream the end of capitalism, when your portfolio is down 50% and still falling, the temptation to give up is overwhelming. This is exactly when you must buy, not sell. Acting contrary to fear requires preparation. Study past crises. Read first-hand accounts of people who lived through the Great Depression. Understand that what seems like the end is actually the reset creating opportunity. Internalize this before the storm hits. Timing is also key. Prepare too early and you miss years of gains waiting for a crash that seems distant. Prepare too late and you're forced to sell into a falling market after losses mount. The answer lies in gradual positioning. Don't wait for the crash to be obvious. Recognize that we're in late autumn and shift assets systematically. Sell 10 to 20% of stocks each quarter, build cash with every paycheck, aggressively pay down debt. By the time the crack appears, you're already in position. You're ahead of the crowd. The cycles we've discussed, the Condraft wave, debt supercycle, and generational cycle, aren't certainties. They're probabilities based on 200 years of historical data. Could this time be different? Could new technologies or policy interventions break the cycle? Possible, but unlikely. These cycles are shaped by human psychology and mathematical limits on debt. Technology and policy influence behavior, but they don't change the fundamental pattern: boom, bust, recovery. What makes 2026 particularly compelling is that we can see stress building in real time. Commercial real estate defaults are rising. Bank reserves are tightening. Consumer savings are falling. Credit card delinquencies are climbing. Corporate margins are compressing. Individually concerning, collectively, they paint a picture of an economy at a late-stage cycle, not collapsed yet, but signaling that a full breakdown is near. If you want to see exactly how to position your money to survive and thrive during this impending collapse, stay with me. This next part will change everything about how you think of wealth. History proves that the right positioning before a commodity of winter creates generational wealth. Investors who bought stocks in 1932 and 33 at the depths of the Great Depression saw returns that ordinary markets could never match. Those who acquired real estate at foreclosure prices in 2009 and 2010 built fortunes that lasted generations. Opportunities like these only appear once every 50 to 80 years. If you're ready, if you have capital, when others are desperate, you can buy assets at 20 to 30 cents on the dollar. When markets recover, that 20 cents can turn into $1, a 400 to 500% return. But this requires going against instinct and ignoring social pressure. Right now, in the autumn phase, everyone seems to be winning. Neighbors brag about investment gains. Financial media celebrates new market highs. Experts say this time is different, that technology has changed the rules. Staying cautious feels like you're missing out. That's the test. Those who resist the temptation to chase returns are the ones who survive winter and thrive in the next spring. Here's what you need to do. Stocks reduce exposure dramatically, not fully to cash, but from 90% to 40 to 50%. Build a cash position to deploy when prices plunge. Real estate, especially leveraged investment properties, reassess your ability to service debt if rents drop 30%. If not, selling early might preserve equity that would otherwise evaporate. For consumer debt, credit cards, auto loans, and personal loans, paying down balances is crucial. Debt is an anchor in winter. It forces you to sell assets at the worst possible time just to meet payments. Being debt-free provides freedom. You can weather the storm. You can buy when others are forced to sell. If you hold significant capital, consider diversification differently. Not across stocks and bonds, they'll likely fall together, but into assets that retain or gain value in crisis: physical gold and silver, productive farmland, energy-generating assets, and businesses that supply essential services. These aren't speculative plays. They're insurance against collapsing paper assets. Psychological preparation may matter more than financial preparation. The commodity winters test resolve when panic sweeps the markets. When headlines scream the end of capitalism,